So dollar averaging is a good way, if you have a lump sum to invest, to make sure you're going to do some kind of, like, spread it out over 4 years, do it every quarter, something like that, 5 years. And that's a conservative idea. Dollar cost averaging is, in one sense, not a particularly productive idea. And that is to say, if you've got, say you come into $1 million from your nice deceased aunt and decide you will average into the dollars, you'll probably do better most of the time. Nothing is universal if you invest it all in the same day.
Right.
That's the plus, because the longer you hold a stock, the better it tends to do. The big minus is that you might have picked basically the day that I was born to start investing in May of 1929, and in which case the $1 million goes to 100,000 by 1933. So dollar averaging is a good way, if you have a lump sum to invest, to make sure you're going to do some kind of, like, spread it out over 4 years, do it every quarter, something like that, 5 years. And that's a conservative idea.
I think the more powerful part of dollar cost averaging really is just every year setting aside money and putting it in.
Well, sure it is, and that is, that kind of option that I just described is not available if you don't have the $1 million.
Right.
So you're starting off, and when stock prices go way up, you're happy. You think, boy, have I been smart here. But you should be sad if stock prices go way down in your, let's say, 6th year of investing. Well, all of a sudden, you're getting more shares for each dollar you invest. So it's a way of eliminating, to the maximum extent possible, the vagaries of the stock market, which in the short term do things for no explainable reason, except the stupidity or hope and fear and greed of investors, all those emotions that get into the game. So dollar cost averaging, absolutely yes, under those circumstances, and those circumstances are the circumstances that will apply to probably 95% of all investors.